Well, we did get a surprise in this morning's jobs report. The unemployment rate fell to its lowest level since March 2009. That's 8.6%. Still, employers added fewer workers than expected. That's a key important point here. And to give us some perspective how to understand what we learned from the Labor Department today is the chief fixed income strategist for Janney Montgomery Scott, LeBas. He's a Bloomberg best, which means he's one of the most accurate forecasters around when it comes to jobs. Guy, welcome to In Business. You say put down the eggnog. Not very excited, you say, about this Christmas hiring trend.
Yeah, not very exciting. I mean, the newspapers are really focusing on the headline of that 8.6% unemployment rate, if you will. But the reality is the sort of sources of this reduction in the unemployment rate are probably not as good as the headline looks. Specifically, a lot of folks are sort of dropping out of the labor force. And I think that's a trend we've seen with discouraged workers increasing month over month, on and off over the course of the last 2 years or so. So it's not as good as it looks on the headlines.
And yet, this is the time of year where you do see at least temporary jobs created, certainly by retailers, as they go into holiday hiring. So to see that kind of exodus at a time when jobs are being created, albeit temporarily, that would seem to be a pretty big point.
Well, keep in mind that all the numbers we generally talk about are seasonally adjusted. Now, if we take out those adjustments, actually the retail industry added about 425,000 jobs during the month of November, which is pretty strong. In fact, seasonally, that's more than normal. It's just not good enough to drive the employment rate down that far. The unemployment rate difference was really the result of people leaving the workforce more than retail hiring.
And so what is the bottom line trend here? Are there signs of hope beyond the retail jobs you pointed out?
Well, I think really what we're seeing is a slow but positive rate of job growth that's likely to persist for most of next year. It's not the kind of thing that really generates a lot of economic activity, but at the same time, we're not nearly losing as many jobs as perhaps we were in late 2009 or so. So we really expect this to be sort of a middling trend, but the reality is unemployment isn't going to return to pre-recession levels until probably 2017 at this point.
2017, that's when the new normal is going to be 5%?
Well, I think the new normal unemployment rate, at least, is probably closer to the 6s right now. At the same time, that would represent sort of a 10-year period from 2007, the start of the recession, to when we return to full jobs growth. And one of the problems is population growth. We need at least 100,000 jobs a month just to account for population growth. So it's very challenging to hit that number.
So, Guy, in looking at the bond market today, I've got the 10-year well above 2%. What is the takeaway for this week's trade in fixed income?
Right. I think if we take a look at the bond market, we had fairly optimistic expectations built in for today's payroll result. And sort of what came forward was, as I noted earlier, mixed. Weak jobs growth, but the unemployment rate fell. And the bond market's kind of reacted neutrally to this news. And so I think we're going to see a little bit more focus next week on Europe.
All right. We can't stop talking about them, can we?
No, we can't.
Thank you very much.